Purchasing a heavy-duty office hardware asset, like a commercial copier, often feels like a logical step toward long-term stability. The goal is simple: pay upfront, secure the title, and eliminate the recurring subscription cost. This strategy prioritizes a theoretical lifetime cost over the immediate reality of business liquidity. It assumes that ownership provides the most value, regardless of how much cash it consumes today. However, the purchase locks vital working capital into a physical asset that begins losing value the moment it is installed on the office floor. The capital expenditure, or CAPEX model, carries three hidden financial drains that often outweigh the benefits of ownership: delayed tax relief, volatile consumable costs, and unmanaged downtime. These combined drains create a severe negative cash flow trough during the first few years of the machine's life, precisely when an SME needs liquidity the most. Transitioning to an operational expenditure, or OPEX model, offers an alternative focused on cash preservation rather than asset accumulation. By renting rather than buying, a business converts a massive upfront cost into a predictable monthly utility. This approach prioritizes immediate tax relief and uses service agreements to hedge against the risks of hardware failure. Hardware procurement serves the business best when it optimizes financial liquidity and operational agility. There is a significant disconnect between how your internal ledger records a purchase and how the LHDN calculates your actual tax relief. Under MASB accounting, a business assigns the copier a 5-year useful life and slowly depreciates its value. But tax reality is rigid. The government dictates specific capital allowance brackets. LHDN grants an initial allowance of 20%, followed by a 10 to 20% annual allowance. Even though the business paid for the machine in full on day one, this schedule forces the company to wait several years to realize the full tax benefit of that expenditure. The OPEX rental model provides a much faster path to tax relief. Rental payments are operating expenses, fully tax deductible in the year they are paid. This immediate deductibility accelerates cash flow. You receive tax benefits in real time, rather than waiting years for capital allowances to catch up to your spending. For startups or low-margin SMEs, this timing is essential for extending the cash runway. An OPEX model prevents the business from extending an interest-free loan to the tax system through delayed capital allowances. Beyond the tax ledger, the daily operation of a purchased machine introduces a variable that many businesses fail to forecast correctly: consumables. When you own a copier, you are solely responsible for the lumpy, unpredictable cost of genuine toner replacements. Retail data shows that a single genuine black toner cartridge for a mid-range office machine typically costs between RM300 and RM500. If your workflow requires color printing or high-yield cartridges, these individual costs frequently climb into the RM500 to RM700 range. These erratic costs make monthly budgeting difficult and create procurement bottlenecks as the office waits for purchase approvals to restore printing capacity. Managed OPEX rental plans stabilize this expense. Standard rental packages, ranging from RM88 to RM288 monthly, bundle hardware, maintenance, and all toner replacements into a single fixed fee. This shifts the financial risk of consumable depletion to the vendor, ensuring you never face a surprise RM700 bill. Moving to OPEX transforms erratic hardware liabilities into a smooth, predictable line item that simplifies the CFO's forecasting. While toner costs are manageable, the greatest financial risk is the sudden, catastrophic failure of the hardware itself. A failed copier in a professional services firm acts as a direct trigger for a cash flow event. The impact cascades through the entire office. Documentation stops, invoicing halts, and client-facing deliverables are delayed. If an office with 10 staff members is paralyzed by a document bottleneck, the company is effectively paying 10 salaries for zero output. At an average hourly rate of RM100 per person, that is RM1,000 in lost productivity every 60 minutes. When you add the impact of frozen billing cycles and stalled project management to this idle labor cost, direct productivity losses for professional firms begin at a baseline of $18,000 per hour. The cost scales even further if the delay causes you to miss a hard deadline or trigger a contract penalty. Factoring in these external variables and potential client churn, the holistic impact often reaches $70,000 or more per hour. SMEs suffer more from this downtime than large enterprises because they lack redundant backup hardware to maintain the workflow. Relying on a standard carry-in warranty for a purchased machine provides no defense against these losses, as the time required for transport and repair can span several days. Unmanaged hardware ownership creates a single point of failure that can silently drain a company's capital during an outage. The goal of a rental agreement is to provide a financial hedge against the high cost of equipment failure. A strict service level agreement, or SLA, guarantees that a technician will be on site within 3 hours of a reported issue. This 3-hour window acts as a firewall, capping the maximum productivity loss the SME can suffer before the problem is addressed. Managed support is deployed directly to the office, removing the delays associated with retail warranties and remote troubleshooting. If the machine cannot be repaired immediately, the vendor provides a temporary replacement to keep the office productive. Strict SLAs function as financial insurance, preventing localized hardware failure from evolving into operational gridlock. Over a 10-year horizon, renting versus buying might look identical on a spreadsheet, but SMEs survive by optimizing for short-term liquidity, not theoretical long-term costs. The OPEX model protects cash flow with zero upfront drain, immediate tax relief, and strict SLAs capping downtime risk. In contrast, ownership locks capital into a depreciating asset and leaves the business fully exposed to the high costs of hardware failure. Modern SMEs maintain resilience by treating IT infrastructure as an agile utility to be managed rather than an asset to be owned. Shifting to an OPEX model is a definitive strategy for preserving cash flow, mitigating risk, and building a more resilient business.